Hi. We'll now carry out inventory accounting in a perpetual inventory system using the average cost flow assumption. I wrote you a little note here. Recalculate average after each purchase. That's what perpetual is all about. It's constantly updating the ledger, and so with the perpetual system, we're going to program the computer ultimately to calculate an average cost each time items are added to inventory. Right. So same transactions. Those should look familiar from the last two. And now, especially now, hopefully you've done this all along, but especially now, pause the video and work it, because there's a few idiosyncrasies that I want you to have strongly reinforced in your mind after we're done with this, so that you know them for the CPA exam and, most importantly, for your practice when you join your firms or companies. All right, so I'll see you in a moment. Welcome back. And once again, there's that the journal entry with the purchase. It doesn't matter what the cost flow assumption is. We just purchased 200 at 28. So once again, let's write ourselves that note. 200 times 28. And of course, it's reflected up here as well. And we now have a ledger that looks like so. Nothing different here. It's looked like this in each of the last two cases because it's the same. Perpetual LIFO, perpetual FIFO, and now perpetual average cost. And now we make a sale, and now the differences between the cost flow assumptions matter. Oh, by the way, the computer will be done this to program, but we'll just show what's in the program. There is the average cost of the 600 balls currently in inventory. There was 425, that cost us $10,000. There was 228, that cost us $5,600. Therefore, there are 600 balls with a total cost of $15,600. So the average cost to the company of its inventory of basketballs is 26. $15,000 divided by 600 balls is $26 per ball. And therefore, when we sold 250 at a price of 50, that's the selling price. Now we have to transfer the sold balls from inventory, and we assume that there were 250 times 26, the average cost at this point. And then after this sale, remaining is 350 at 26. It's 350 of those 600 still at 26. And when you posted it to your ledger, it should look like that. This time, the cost of that sale is assumed to be $6,500, which is in the middle of the cost of goods sold under LIFO, which of that sale, which was $6,250, and the $6,850 when we assumed last in, first out. So 6250 under FIFO and 6850 under LIFO. 6500 under average cost in the middle of the two. Now we make another purchase of 400 at 30. And we add those into the 350 at 26 that we had in inventory already. We now have 750 at a combined cost of 21,100. So when you divide the cost of the balls we have in inventory by the number, you get $28.13.3. That's our average cost, which we will apply now to our sale of 200 on January 25th. And then remaining in inventory after that sale is 550 at an average cost of $28,133, or $15,473.33. And when you posted all this to the ledger, it looked like that. And so cost of goods sold this month under the average cost assumption was $12,126.67. Under the FIFO assumption, the total cost of goods sold for January was $11,400, much lower, and it was higher at $12,850 under LIFO. Now it's in the middle under the average cost at $12,126.67. So there's cost of goods sold, and there is ending inventory. Once again, the cost of goods available for sale was that same $27,600. Of that $27,600, cost of $12,126.67 was sold, and $15,473.33 remains in ending inventory. All right. And that is a illustration of the perpetual inventory system, where we applied first FIFO cost flow assumption, second the LIFO cost flow assumption, and third the average cost flow assumption. And remember, under these we had fairly different cost of goods sold totals. Well, here's the thing. When cost of goods sold is higher, the bad news is net income is lower. So the board of directors might be a little less impressed with our net income. But then there's good news, because our cost of goods sold on our income tax return is higher, and therefore we pay less taxes. So when you're choosing the cost flow assumption, among the reasons to make the choice, if you're mostly interested in minimizing taxes paid, and you're in a rising inventory price environment like this company is we just looked at, you'll want to choose LIFO to minimize the present value of taxes paid. If your primary focus is reporting a high net income, then you'll want to choose FIFO in a rising cost environment. And then average cost lies in the middle. Average cost is used a lot by, for example, like Coca-Cola might choose the average cost because it's truly exactly what's going on as they pour all the ingredients in the vats. Anheuser-Busch, so I don't know what cost flow assumption they use because it doesn't have to reflect the physical flow of the inventory, but those are the kind of companies that might choose the average cost. All right, and that's perpetual inventory accounting under the 3 cost flow assumptions. In the next 3 videos, we'll apply the periodic inventory system under the FIFO cost flow assumption, then the LIFO cost flow assumption, and then the average cost flow assumption. All right. Thank you for your attention and hard work.